of investment. If you went to a traditional custodian, someone like Charles Schwab or Fidelity, Bank of America, any of these people that typically would hold your retirement accounts after you've had a 401k, your traditional IRAs or rollover IRAs, and said, hey, I want to buy some private notes with my retirement. It would be much like this fellow talking to this kitty. It'd be, no, you're not allowed to do that. Never, ever, ever think outside the box, which is good advice if you're a kitty, but probably not a very good advice for you, because what Charles Schwab and Fidelity do is a little bit different than what we do at Quest IRA. At Quest IRA, we have a philosophy that you don't really have to think outside the box, because the box will always be bigger than you think. And I think that's a really important attitude to have when you're looking at investing, because investing, there's usually always a better way and a more efficient way to do most things that you do. And if you're not constantly looking to improve how to do things, you're probably missing some of the profits that you could be having with your things. But certainly, a lot of people don't understand what a self-directed IRA is. And the truth is, I like to say, an IRA is an IRA is an IRA. There is no legal distinction with an IRA held with a company like Quest IRA or an IRA held with a company like Charles Schwab. I kind of like to pick on Charles Schwab because I think they're a really good brokerage house, by the way. So, and you'll understand something here of difference. There is a difference between us, but not in the way that we do our rules. You see, if you take your money to Charles Schwab, he has a job to do. It's his job to sell you investments. And he's a licensed securities agent that allows him to sell the investments that are publicly traded assets, like stocks, bonds, mutual funds, CDs, these type of things. The investments that most people are used to in common with. At Quest IRA, we are not licensed securities agents. We cannot sell you investments, but this allows us to hold any type of investments, including all types of private investments, including notes, real estate, and other things. So the difference between a self-directed IRA and an IRA with a traditional custodian is that we're not licensed securities agents. We are not selling you investments. And most of our clients actually have an account with both and move the money back and forth. Because as you have cash sit with a company like Quest, that's exactly what it's doing. It sits there earning no interest. So at Quest, we have no minimum cash requirement fees. And so if you, say, invest in a note, you don't have to move all your money over to Quest. You just move over the portion of it that you need to do that particular note. As you start to get payments back from that note and it builds up cash in your account, you may want to, from time to time, sweep that out back over to Charles Schwab or Fidelity or whoever you're using in order to be able to keep that money moving. And as long as we're doing what's called an IRA to IRA transfer, we can move that money as many times as we want back without any penalties or without even notifying the IRS, because it's going from a licensed custodian to a licensed custodian. So again, self-directed is really just a marketing term trying to describe what we do. There is no real difference. The difference is we're allowed to hold private assets and they hold publicly traded assets. So benefits of having a self-directed IRA. There's several of them that I like to talk about. One of the big ones is what I call true diversification. I think that a lot of people are trying to diversify, your investments by having different areas of the stock market. But the problem with it is you're still all tied to the stock market. And one of the largest segments of our economy is real estate, or is the largest segment of our economy. And so if you don't have some type of holdings related to real estate in your retirement accounts, I feel that you're probably not truly diversified. Please understand what I'm saying. This does not mean that everybody should be a property manager, because there are some people that are god-awful at managing property. I happen to be one of those people. I'm horrible at it. I don't like dealing with tenants. I don't like dealing with contractors. I'm very busy. I don't like to do those type of things. I much prefer holding paper. I'm being on the note side of it or being a passive investor in some type of real estate deal than buying one-on-one rental property. That doesn't mean that that's not what's good for you. I'm just describing what's good for me personally, as I enjoy buying the more passive investments and allowing professional real estate investors to do the other types of work. Other benefits of self-direction is that if you're doing it right, you can sometimes take your skills and grow your wealth tax-free. In today's environment, I think it's very, very important to pay attention to anything that you can do to leverage your advantage against the IRS. There is a ton of new auditors that are coming online for next year's tax year and the tax year after that. And it's going to be a battle going forward for a lot of America against the IRS. So we have to understand the tax rules and use them to our benefit. And using self-directed IRAs and the educated staff from a company like Quest is one of the great tools that you have in your battle against the IRS. But probably the biggest and most important benefit to me relates back to investing in things that you know and what I call social investing. You see, I have an issue with most Americans and the retirement account. I get the privilege of being able to speak pretty much across the country and to different groups. And I ask the question all the time. I'll look at someone says, does anyone have any mutual funds? What are they invested in? And I call it, I get the penguin. The shoulders go up, the arms go down. Most of the time people don't know. Or they'll tell me, well, it's invested in large caps or international growth fund or something along this line, trying to sound smart. But when I peel the onion back a little bit further and say, no, what are the companies you're actually invested in? Most of the time people don't know. The problem with that is when you're invested in something and you don't know, it's kind of like your teenage daughter. At midnight, you should know what your teenage daughter's out doing. Because if you don't, she's probably out doing something that you don't want her to be doing. Your money works the same way. And this reminds me back to before my time of self-direction, and this is one of the things that actually led us to doing self-direction, and eventually led me to be the CEO of this company, was I had peeled open one of my 401ks and started to look at the actual holdings inside the 401k mutual fund, the mutual fund that was inside the 401k. And I was astonished at what I found. One of the big ones that caught my eye was one of the largest holdings this particular mutual fund had was Bin Laden Construction. This was shortly after 9/11, and I was pretty upset about that particular fact. As I started to look at other companies, I found a desalination plant off the coast of Africa. It was making clean water, but it was doing it by boiling ocean water with crude oil and dumping stuff back in the ocean, and also selling the water to needed people at a very exorbitant price. There was a child labor camp making tennis shoes in Pakistan. There was a company in Brazil that was doing animal experimentation that wasn't allowed in the United States. My point being is, unbeknownst to me, there was my money was being invested in companies, though they were profitable. They were companies I would never invested in because they weren't in line with my ethical or political intentions. If I'm buying a note or buying real estate or buying my typical self-directed type of investment, I know what I'm investing in. I can drive by it. I can see it. I can touch it. I'm investing typically in my own community and certainly in my own country where I know where things are happening. My money is stimulating the economy. As I am receiving an above average return, I'm also can get a nice warm and fuzzy feeling about my investment because I'm investing in things that I know and understand, and I'm also investing in things that are going to stimulate the economy where I live, work, and play. So I think the social aspect of the investment is important to talk about. I probably spent too much time on the slide, but it's one of the things that I'm passionate about. There are different types of plans that can be self-directed. right now. And I'm going to break these up into different types of plans, the personal plans, employer plans, and we have some specialty plans. The personal plans are our traditional IRA and our Roth IRA. The difference is a traditional IRA, we put a little bit of money in, we get a little tax deduction. When we grow older, supposedly we're making less money, above the age of 59 and a half, we can take that money out. And when we take that money out, it will add to our modified adjusted growth income at that time. We're not supposed to be working, so therefore we would pay less tax is the general idea behind it. The Roth IRA is a lot more fun. You put the money in, don't get a tax deduction, but if we can grow that money into a lot more money, it grows completely tax-free. That's a lot of fun. So a lot of investors in unusual investments like notes and real estate often talk about the Roth IRA. But the traditional IRA has a very, very important role and is sometimes left out. And the reason why the traditional IRA is very important is because if I had a 401k or 403b thrift savings plan and I've had separation of service, typically that money will roll into a traditional IRA. In other words, that's where most Americans have their money, is in their tax-deferred bucket. Now, but if we had a bucket of money or that is tax-deferred, we've worked at the widget factory for 23.4 years, putting both B on nut A. Every month I put a little bit of money into the account. Every month my employer put a little bit of money in that account. We both got tax deductions when that happened. So I have what seems to be a big bucket of money. You know, we're pretty excited about this. But if I really look at it and examine that bucket, it's not quite as big as we think it is. Because each time I go in there and dip a little bit of money out of that bucket to spend something for myself, who's there? Why, of course, Uncle Sam, standing there looking in my bucket like, what's in your bucket, man? Right? You know, he wants to know because he's going to be taking a piece of that. So I'm not going to spend much time on this topic, but I think it's important. I'm going to plant a little seed because there is something that we can do a little bit differently, which is we can convert our traditional IRAs to a Roth IRA. Anybody in America can do this without penalty since 2010 because the income cap for doing a conversion has been permanently removed. So you can move your money from a tax-deferred bucket to a tax-free bucket at any age without penalties. But of course, there's a problem. It doesn't create penalties, but it does create taxation. So in other words, in the year that we do that, we add that taxation to our modified adjusted growth income. And doing that, I want you to imagine for a minute your average person of retirement age, 60, 65 years old, walking into their average financial planner and they go, hey, I've got my bucket of money, but I want to move it over to that Roth because I heard that Roth IRA is really cool. What would the financial planner tell that particular individual? Well, this conversation will go something like this. Wait 1 second, we have a problem. The problem is you're old, and it took you a long time to make this money. And we want to be very safe with this money that we make. And if we move this over to a traditional IRA, from a traditional IRA to a Roth IRA, it's going to create taxation. And because we're keeping your money safe, we're not getting a very big return. We're keeping it in CDs and bond funds. They're paying 1 or 2%, something like that. So it would create a lot of taxation. You're still working right now because I'm not paying you very much return on your money because we're trying to keep it safe. Therefore, you would have a large tax bill and a low return, and it's going to take a long time for you to make that money back. So I don't think that it's a good idea. And based off of that financial planner's information, that's true. But as soon as we put an investment in it like notes, where we're getting an above average return on that investment, life changes. You see, if I do a Roth conversion early in the year, January, February, March, or even right now, I don't have to pay that tax until April 15th of next year. If I did it in January, it's conceivable that I could collect a whole year or even 15 months worth of interest from that note prior to even paying the tax. In other words, because of the increased returns, it all of a sudden becomes more important to consider doing a Roth conversion on these types of investments. And what's nice about a Roth conversion is if we make the choice to do it, we can always recharacterize it back if that choice ended up being a bad choice. We have until our filing deadline plus extensions, October 15th of the following year, to hit the oops button and say, well, hey, I didn't really mean to do that. You know, I can't pay these taxes, or this investment didn't turn out the way I thought it was, and convert it back. Again, we have a whole class about that. I have 14 IRA specialists on staff. They can answer your questions about Roth conversions if you have any questions about that. But I just wanted to plant that as a little seed, because some people don't think about it, and it's better to think about these things prior to us doing a nice investment instead of after, because sometimes it's a good idea to pay our tax on the acorn instead of the mighty money tree that we're going to grow it in through our investments. Other types of plans that can be self-directed are employer plans, like SEP IRAs, simple IRAs, or one of our most powerful accounts, the solo or individual 401k. Do not get these mixed up with having 401k funds at a job that you're currently employed at. Typically, if you're currently employed, you're locked into the investments that they have available to you. You know, but as soon as we've had separation of service, we've left our job, or we could die, but it's usually better to leave the job out of the two choices. But as soon as we've had that separation of service, we can roll that money into one of the self-directed type of plans. These employer plans are great for people who are like realtors or doctors or self-employed, small business owners, those type of people. We can also self-direct those types of plans. And we have two other types of plans that can also be self-directed. Coverdell education accounts, these are for minor children to pay for education expenses from kindergarten all the way through college. You don't get a very large contribution on these type of plans, but you can invest them. Or health savings accounts, a very misunderstood account because it's often mixed up with something that's called a flexible spending account, where you get to the end of the year and use it or lose it. Health savings accounts are very, very powerful, even in the day of Obamacare and stuff, and we can use health savings accounts to, and I call them the best of both worlds, because you put money into a health savings account, you immediately write it off your taxes. It grows, and you take it out for qualified medical distributions, which is actually very, very broad. That money comes out completely tax-free. Again, just touching base on those, we have a class just about these particular classes that you can catch online. All of those accounts that I was just talking about can be invested in self-directed accounts, and they can also be partnered together. Often when we look at someone's home, they might have a Roth IRA and a traditional IRA, and their wife might have a Roth IRA, and they might have a Coverdell with a little bit of money in it, and a health savings account with a little bit of money. We can combine all of those to purchase one note. When we're looking at the overall amount of money that's in retirement accounts, you'll find that most of America's wealth is held in retirement accounts. Over 24 trillion with a T dollars of money is in their retirement accounts. Most of the time when you're going to the bank and borrowing money to buy a car or a house or anything, you're really borrowing from someone's retirement account. And less than 2% of this is self-directed. The rest of it is available, and it's mostly because people don't know about self-direction or what to do with it. What type of assets can you invest with a self-directed IRA? Just about anything that you can take title to that you might be knowledgeable about. Of course, we're talking today about promissory notes, but you could buy all types of things, including all types of real estate, single-family and multifamily homes, condos, commercial property, tax liens or tax deeds, unimproved land, foreclosures, apartments, joint ventures. You can buy property in another country. You can buy property that has debt on it. Deeds of trust or mortgages, which is really notes, what we're talking about today. But if you can take title to it, you can probably own that in an IRA. I hope this little bit of information was able to give you a little bit of information to think about some stuff. On the screen, you can see my personal email address and an 800 number for us. And I'm happy to answer any questions, and if for some reason you can't get a hold of me on the phone, you can just ask to speak to an IRA specialist, and you'll find our IRA specialists to be highly educated. They're all certified IRA specialists, so they've all been through years of training in order to obtain that title. Hopefully this gives you a little bit more information to go on, and I want to thank you for your time. Do I have to? Rich, I'm going to turn it over to you. I think Rich is just pulling up the stuff. He'll be with us in just a second.
I had myself muted, so there we go. Can you hear me now? Thank you, Nathan. Appreciate your information you just shared with us. I can vouch that Nathan's crack team of people are IRA specialists are professional and well informed and well educated. I think they're one of the most educated companies, self-directed IRA companies in that arena, I think, at this point in time. So,
well, that's a big compliment coming from you, Rich. Really appreciate it. Thank you.
Well, I spent some time with Quincy on the IRA Fund Cruise back in January, and I got to know a couple of your young ladies and stuff, and they were extremely knowledgeable and friendly. And of course, Quincy's a wealth of information by himself, and just loves to talk about this stuff, and just had a real good time and real good experience with Quest. So, that being said, my name is Rich Brewer. I'm with Jackie Stark, and we are Note Brew. We invest in real estate mortgage notes, and more specifically, defaulted mortgage notes. We buy toxic assets from the banks. Kind of our agenda for today is what we're going to get out of the class. Kind of give you a slight introduction to notes, why invest in notes, and how to get started. And obviously, we all have to have our disclaimers and stuff, and this is ours. This is an informational webinar. Any views expressed during this presentation are solely the views of the presenting party, and they do not represent nor are endorsed by the self-directed IRA custodian. Why notes? Why now? Yeah, I've got a friend that he talks about CDs as certificate of disappointments, and just looking at the current CD rates, a 9-month CD is at 0.5%, 13-month CD is at 1%, and a 2-year CD is at 2%. Don't know about your what everybody's wanting for the return on investment, but for me, that is way too low for what's out there and what we can do, and we can do a lot better than that with what we in our defaulted note space. The stock market's another area that you could invest in, as Nathan was saying earlier. But the volatility of the stock market, you just never know what you're going to get from day to day. Whether you have high ups and downs, and if heaven forbid if the stock market crashes, at the end of the day, all you're going to be left with is a piece of paper. There's nothing tangible with that whatsoever, and a lot of people felt that back in 2007, 2008. And even when the tech bubble crashed in the late 90s or early 2000s, everybody had big swings in their account values in the wrong direction. Mutual funds is another area that some people might be able to invest in, and it's kind of amazing that only 4% of mutual funds match the index they follow. They change every year, and there's over 10,000 mutual funds to pick from. Don't know about yourself, but that's almost paralysis by analysis. There's just so many out there that to pick from, that how they're doing and everything. So we just we like to think and invest like the bank. We always like that cha-ching, but we're not thinking like the traditional bank. Traditional banks think that defaulted notes are toxic assets to them. They're in their they're in the red with toxic assets. But for us, these are valuable assets. That's how we buy assets or buy defaulted mortgage notes at discounts, and that's why they become valuable assets for us. So starting with the basics, what is a note? A promissory note is a financial instrument where one party agrees to pay a specific sum of money to another party under specific terms. An example of this would be like $20,000 at 4% interest over 5 years. Your terms are kind of nailed down and they're specific. You know what you're getting. Now, a mortgage, it secures or ties the note to the property, and it's made by the borrower to the lender, pledging the property until the note's paid in full. And that's how, as a lender, you can go back and get possession of the property through foreclosure, or you can do a remodification to help the borrower stay in their home. You have that power of the collateral of the property. When we typically talk to potential investors and stuff, we always try to cover their main concerns, and we invest in first mortgages and second mortgages, and we try to explain the differences. And I'm just going to go over, touch base over a few here on both first and seconds. That typically, when we're looking at first mortgages, our price points are higher on the first liens or first mortgages, and that's because we're in the first position. There's nothing that there's not very much that can wipe you out. If you're in a second position or you have a mechanics lien on the property, a first mortgage can wipe you out if it goes to foreclosure. Now, second mortgages, people don't realize this, but you can still control the property if you own a second mortgage. Now, the evaluation process is a lot different than the first. When you're looking at a first, you're typically looking at the values of the property, the areas and stuff. When you're looking at a second, you're primarily looking at the borrower's credit. You're looking at how the borrowers are doing, what kind of blip they had on the radar, what caused them to get in the mess that they're in. I'm going to probably say this quite a bit in the next 10-15 minutes, is that all of our notes are secured by real estate. Everything that we buy has a tangible asset, a tangible piece of property that's tied with it, and that's just so we can secure our investment. Obviously, one of the biggest things is how long will it take to see returns. We typically like to start giving returns out by the third or fourth quarter of the first year. Once we do our acquisition and start doing the workouts and start bringing everything to kind of through our pipeline. And typically we do a capital lock for the first 3 years, and we start returning capital after the third or fourth year. Now, the big question is, can you lose your investment? And the answer to that is just like any other investment. It's always possible, but like I said earlier, we like to buy stuff that has tangible real estate with it. So the chances of that happening are extremely slim. It's not like if you own a stock that goes down to nothing, or you own stock in Enron that when Enron crashed, that you lost everything you had. We like to have something that's tangible with that. Risk management. We want our investors to understand and know what they're investing in, kind of what our processes are, and how we kind of handle things and what we go through. We try to educate them on the different exit strategies, on how we make money, and what we try to do as a company. And one thing as we try to do as a company is keep people in their homes. We want to do workouts and keep that pride of American homeownership alive, through the country. And I think that's one of the things that we're big on, that we think is going to help save this mess that happened 5 years ago, or I guess 6 or 7 years ago now. Time's kind of flying by, but so we try to educate them on the different exit strategies that we have. One thing we try to do is we try to spread our risk across several different assets and several different markets. We like to be diversified. We don't want to be too heavily in one area in case something happens. That way we can, we have a good diversification of assets. Our due diligence is done by our crack team that's done prior to acquisition and stuff to make sure all the T's are crossed and all the I's are dotted, just to make sure that everything is what it is. It is what it's being represented as. Make sure there's not, there's all the documents are there with our collateral files and stuff, and just make sure that we're not buying anything that under false pretense. And the biggest thing is we work with select hedge funds to acquire our product at premium prices and stuff, and we try to buy in big enough blocks to where we can get premium prices. Investing in real estate notes. As I said earlier, our notes are secured by real estate. Everything we buy has a piece of tangible property tied to it. We don't do any unsecured mortgages, or we don't do any unsecured notes or promissory notes. Everything is secured by a tangible piece of real estate. As I said earlier too, that we like to keep people in their homes. We like the remodification process to where we can keep people in their homes and they can continue paying or restart paying, do a kind of a reset or a restart on their payments. And that's one way we get high yielding monthly mortgage payments to ourselves and our investors. We also have other exit strategies that boost our yields. We're in the middle of doing we foreclosed on a house in Columbus, Ohio, and we're going to do a light rehab on it and sell it. And we're going to make a pretty good chunk of change on that one. Our return on investment is going to be pretty high on that one. So not everything can be a remodification. Just sometimes people don't want to stay in their homes. Sometimes because of bankruptcy, they have to sell their homes, or they have to deed it back to us, and kind of just the different exit strategies that we have to go through. And the biggest thing, like I said earlier, is we're providing relief for troubled homeowners where the banks and the governments have failed. It's just by keeping people in their homes, we have a lot more flexibility than banks do. We can do different payment plans. We try to custom tailor fit for the homeowner to make sure that they can make their payments. We never want to do a remodification on a note or on a mortgage note and have somebody fail within the first 6 months to a year. We don't ever want to have them fail, but we want to make sure that it's a win-win for them, and make sure that it's not going to put, we don't want to set them up for failure. So that's one thing that the banks have not been able to do through this whole process. So how is it an everyday investor can play in the same arena as these giant institutions with trillions of dollars? Until recently, we couldn't. Individual investors have not had access to significant note opportunities. Then came the subprime mortgage crisis of 2007-2008. We all remember that the recession began due to lenders issuing subprime mortgages as a way to satisfy mortgage demands and make millions in fees for themselves. However, when this imploded because homeowners could not meet their payments, as interest escalated, the government stepped out and issued bailouts. TARP was a $700 billion bailout for the banks, and Freddie Mac and Fannie Mae got another $400 billion shortly thereafter. Bank after bank was going under because they couldn't meet the reserve requirements. Now this chart kind of shows what happened. Kind of the bank, how the bank got to the banks got to the big four. It starts at 1995. If it's a little fuzzy, on the left-hand side it starts at 1995 and it ends up on 2009. And it just shows how everything got just kind of consolidated down to the big four with Citigroup, J.P. Morgan Chase, Bank of America, and Wells Fargo. There are a couple movies that kind of, I guess you could say they're documentaries on what all happened. One of them was called Too Big to Fail, and the other one's called Margin Call. And it really gives a window. It shows you, it lets you look into a window as far as what happened during this debacle, and kind of what happened and what all was going on when everything was melting down. One of the biggest things that we're always asked is, how much product is there out there? What kind of, how much product is there, and And what we're being told right now, there's $800 billion in delinquent mortgages that they haven't made a payment in the last 60 days. That's 800 billion with a B. So there's still a tremendous amount of product out there, and we're being told that there's a 3 to 5 year window, and that's always a kind of a moving target. Some say it's shorter, some say it's longer, but so we're trying to kind of build this while it's kind of while we're in the middle of it. So this is why we invest in notes. We enjoy the high yielding passive investments provided from our self-directed IRA or outside your IRA. You can just by getting the monthly mortgage payments on the remodifications, it can literally blow your self-directed IRA up, or even your personal investments. The banks have been talking about this for years. Banks have been taking advantage of this for many years, and now the opportunity is available to us. And my only thought process is, why not? Why not us, and why not now? And probably the biggest thing is because we're keeping the American dream alive. By keeping people in their homes, we are keeping the American dream alive. And we're helping everyday people out that are hardworking Americans. We're keeping, Nathan said earlier that a lot of his retirement funds were overseas and stuff. This is where we can keep it all in our country and help our country get back on track. So how can you invest in notes? From the different sources: cash, self-directed IRAs, your self-directed 401ks, really any account that Quest has, whether it be a Coverdale, whether it be the health savings account, can be invested in notes. And you can use it to buy performing notes, reperforming notes, non-performing notes, or even invest in a note fund and a note fund. And the biggest thing is these are all passive. There's nothing that really is active for an investor to do. They're all passive for you. Now this is an example of basically a $100,000 investment, and as you can see, there are no returns in the first and second quarter of the first year. But at the end of the first year, you will have caught up, and you've received a 12% return. The first 3 years yield a projected return of $12,000 per year, and at year 4, after the principal lock is lifted, you will see a greater return with your capital built back into your quarterly earnings. At the end of your 5th year, you will have earned $60,000, and your capital will be paid in full. So that's just kind of what our game plan and an investment strategy that we have with our investors, and kind of what we have been doing. So that is all that I have. My name is Rich Brewer. I'm with Jackie Stark. Our information is below. If you have any questions, please email us, or if you have any questions on here, we'll stay on for a little bit to see if anybody does have any questions. We'd be more than happy to answer them. I want to thank Nathan and the Quest team for allowing us to do this webinar together, and I'm really grateful for them.
Thank you for having us, Rich.
Well, it's a mutual gratification. I appreciate us being able to co-venture on this and everything. So, going to hang around for a little bit for questions and stuff. Do you have any good stories like Quincy does, Nathan, or as far as your IRA and stuff?
Oh, I have tons. I don't know that I tell them as well as Quincy do, but I think that one of the biggest and wonderful things about my job, or what I love doing with my job, is you find people who have done everything right all their lives. They've worked hard. They got a good education. They put 10% aside. They didn't worry about the ups and downs of the stock market, and they're at retirement age, and they find that they don't have enough money to retire because the returns are so low. And they discover an investment like this that can be safe, provide higher than average returns, has socially acceptable parameters to it, and it's a life-changing event for so many Americans. And that's the best part of my job, when I see that happen and see them like actually retire, actually have income, actually can develop true wealth for themselves and to pass it on. Like I said, it makes what I do very, very worthwhile.
I can only imagine. I can't. It's interesting. It's hard for me to fathom that there's only 2% of IRAs in a self-directed IRA accounts. I mean, that's hard to. Out of the $24 trillion that's out there, only 2% of it is with.
Well, we're working on trying to educate people, but it's a lengthy process, and of course we're battling large institutions. So
right, that's kind of the uphill battle, but it's a real estate and even the paper world that we live in and stuff. There's incredible returns to be made out of it, and there's the real estate is so prevalent in outside of your IRA and stuff, that you would think it's only a matter of time before it gets into the IRA, or into the IRA arena, if that makes sense.
right.
So
I agree with that.
well, I think we have no questions, so I think we're going to go ahead and we will go ahead and.
Well, I look forward to the next time I see you, and thank you guys, and have a great evening.
All right, you too. Thank you.
Bye-bye.
Bye.